Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.
Hello and welcome to Nirmal, ladies and gentlemen. I'm Hiral Dadia. We have with us Mr. Girish Kousgi, MD and CEO at Canfin Homes, joining in. Girish, pleasure to speak to you and good to have you on the show. My first question coming to you is from March to now, a lot of unprecedented times that every one of us have faced. Corporates have seen the same as well. How would you describe the entire transition?
Uh, yeah, I think from March till now, that is start of COVID, during COVID, and almost at the fag end of COVID, we've seen phenomenal changes in business models and the way we work. I think this is one of its kind event, maybe in last 1 century, and therefore I think a lot of companies had to adapt. So we also did that. So we focused more on digital to try and get to customers. We covered all the customers, and for first few days during
Mm,
lockdown, we couldn't really go out and do business, and therefore we were trying to focus only on collections and recoveries. So I think the entire model changed. I think as a financial company, we also realized that we can do a lot more digitally, which we thought earlier, it was not possible. So it's a big lesson. But yes, I think we did pretty well during COVID time, and now we are back. Now COVID is over and out almost, and we are back to growth and all of the key parameters the company is concerned.
right. So with this, Girish, I think when earlier in the month of March and April, when we were discussing the same with corporates, the concern that time was we don't know how the future or the next 3 to 4 quarters are expected to look like. However, for a lot of corporates, the financial numbers have really spoken out well and have given an indication that the numbers have been way above what even they themselves were expecting. Has that been the situation for a Canfin Homes as well, if you have to take the first 3 quarters?
Yeah, absolutely. If you look at first quarter, really we are very apprehensive as to how will the market respond and how we will adapt in terms of doing business, and I think more to manage the book because
Uh-huh.
COVID and morat all the stuff. So quarter one was basically trying to cover all the customers, get their awareness, so that we can help out customers to avail moratorium. And our focus was completely on customer engagement and collections. So we did very less business in quarter one. I think we did for only for about a week, I guess, if I'm not wrong. Then Q2 was definitely better. It was still during morat period, COVID period, and therefore the focus was on both collections and business. Q3, I think I would say largely the focus was on business because we had got a sense with respect to our NPAs and overall delinquency. So what it turned out was we were very apprehensive in March, April as to more so with respect to the portfolio quality, not really in terms of business. Because if your portfolio goes bad, it takes really 2.5 to 3 years to get it back. But as far as business is concerned, it's only a question of a quarter you can get back business. So we were not really worried about the business, but we were not worried about collections and recovery. But yes, we focused more on recovery and collections. We focused more on liquidity and profitability during these quarters. Not that we didn't focus on business, as in when markets opened up, we also did business.
Hmm.
But quarter one was largely customer engagement and collections. Quarter two was both collections, customer engagement, and also business. And quarter three was more focused on business and collections more on a maintenance mode. I think Q4 is we are in a sweet spot. We have good control on asset quality, and also we've shown significant growth in quarter three. If we shouldn't compare YOY, it may not be fair to compare YOY, but if I have to look at within quarter three, our disbursement for the month of December
Hmm.
was 50% of the quarter. I think that talks something about the market opening up and all
Hmm.
of that
Hmm. Hmm.
towards that. So I think now COVID is almost over, but we still have to watch our portfolio for next quarter or so. But yes, business is completely back. So Q4 onwards, it will look really nice.
Right. So when we're talking of business as normal from the fourth quarter onwards, initial quarters, the concern was as how the asset quality is going to pan out from here on. Yes, we have been pretty well enough in the first three quarters. However, do you think from here on there is a possibility that the asset quality would worsen not only for a Canfin homes, but also for other financial institutions taking the moratoriums into consideration, taking the other schemes that the government and the RBI has provided into consideration?
I think most of the companies amongst NBFC space and HFC space, they have given some kind of indication on the pro forma NPA, that is actual NPA and deemed NPA. So now I think everyone has a sense.
Uh-huh.
So Murad got over in the month of August. So September, October, November, December, and Jan. So at least even if you take till Q3, it is 4 months after Murad.
Uh-huh.
So what typically happens is that during morat, uh, people who opted for moratorium, they would have little excess cash flow. So immediately after morat, you will see collection percentage or collection efficiency will show much higher than even pre-COVID levels. So one should not get really carried away, and therefore 4 to 5 months is the reasonable time to assess how good the portfolio is in terms of where will the NPAs end.
Uh-huh.
I think now most of the companies have seen that. Maybe some companies might need a couple of more months, let's say Jan and Feb. I think broadly everyone in the industry and every single company knows where they will head with respect to asset quality. I think asset quality risk is reduced to a large extent as we talk, in the month of Feb.
Right. So are we, but is it right to say that we will still remain below that 1% bracket on the gross NPA front?
See, it's very difficult to say. See, whether it is little less than one or little more than one shouldn't really worry at all, because what we should see is that what was your Morad book
Uh,
and what percentage actually has flown into NPAs,
uh,
or what was the NPA base and what is the increase. We should look at that because, for example, if somebody is at 2% NPA and if it, let's say, increases by 25 or 30%, I think that shouldn't be a worry at all. So I think the 1%, we are the lowest today in the industry. We hope to be the lowest going forward as well.
uh,
However, I would say our attempt is to ensure that, see, as of quarter three end, we were less than one, including deemed. Our actual NPA was 0.68, and
uh.
if we had to take into account deemed NPA, so it was less than 1%. So we hope this trend would continue. But yes, if there are 2 3 bips here and there, that shouldn't really worry anyone.
Right. And overall, when we are saying that the demand has come back as well, so is it right to say that there will be no challenges in terms of book growth or disbursement growth going forward?
If I have to talk about Canfin, we don't anticipate any
Mm,
challenge which is different from what we saw probably a year back or 2 years back. Now, if you talk about industry, yes, industry, especially HFCs and NBFCs, would probably face bit of challenge because now private banks and PSU banks, they become more aggressive on mortgage, because
mm,
mortgage part of retail, corporate has not really kicked in, and SME also is, there's some time to cover. So there's a lot of focus on retail secured, within secured mortgage, and therefore there is heightened activity in mortgage business. So all the big banks, both private and PSU,
mm, mm,
very focused now, and they want to grow their book in the space. A, B, if you look at the rates are at rock bottom. Now banks are in a position to offer the lowest rate because their cost structure is different. They literally get card zero and at hardly any rate, and therefore they're able to manage their cost better. Now in that sense, there will be lot of flight of book from NBFC and HFC to banks,
mm,
because all the loans which are at high yield might see a switch from NBFC, HFC to bank. This is one risk probably the industry might see till such time corporate and SME segment picks up. Now, talking about Canfin, our rates are cough is the lowest in the industry, right? If you look at our
mm,
incremental cost, it is less than 6%, it is 5.5%. And if you look at our lending rates today, as an offer, it starts at 6.75, right? So our card rate is 6.95. So today we are competing with, on rates, we are one of the best in the industry.
mm, mm,
They're not a year back, but now very clearly our focus is to retain the book A, B, and also to grow our book. And therefore, we have become very aggressive in terms of pricing. That's because of our cost. Our cost is very low. We are able to manage our cost very well. And therefore, we will not anticipate any major risk or threat to the
mm.
company per se. It is same what it was maybe a year back or maybe 2 years. So that's how we are placed.
Right. So when you're saying that, we will be aggressive with regards to pricing, number one, by how much are we expecting disbursements and the book to grow? Do you think we will be able to maintain that 18 to 20% or something upwards of that? And secondly, on the back of the aggressive pricing strategy, what's the kind of impact that we could see on the net interest margins? Because I think the previous quarter as well, we clocked little over 4%. Is that something which is sustainable?
So coming year, business should not be compared with this year because this year, literally first two quarters were wash out. And
Mm-hmm.
compare coming year with the previous year, right? I think from this quarter onwards, you will see, very good growth in book as well as disbursements on a steady state, which is maybe another couple of quarters. We should be able to see a growth of about 17 to 18% on both book and disbursements. That is because of a pricing strategy, and the market is very robust now. So earlier, because of our pricing, we were focusing on certain segments. Now, since we have dropped rates, a lot of the entire market is opened up for us. So we can now get into every single space on the retail side. So that will give us lift in our disbursements and therefore book growth. Now, yeah, at least for next couple of years, we can definitely show a very good growth, and after that, maybe it might consolidate.
Mm.
So in steady state, I think anything growth, anything over and above 15, 16% should be good enough. Next 2 years could be slightly higher.
Right. And from what segments?
And the margins,
Okay. Yeah. Go on.
today, if you look at margins are very high. If you look at the profile of Canfin, we are
Mm,
99.9, almost 100% retail,
mm,
largely into affordable. We don't do high ticket. We are not exposed to developers in terms of construction finance. We don't have any corporate lending. And therefore, it is almost 100% retail. Our builder book is less than 2 crores on a book of 21,000 odd crores. So it's hardly anything. So considering the profile of Canfin, we feel that a NIM of 4.12, and today our spread is 2.91. This is a very,
mm,
and since we are now very aggressive and we want to grow at a much faster pace than we did in the past, we feel that both NIM and spread both are not maintainable. It's not manageable to maintain at these levels. It will come down, and we are, as a company, will be quite happy if we're able to maintain NIM of 3 plus and spread of 2.4. So
mm.
3 and 2.4 is what we are ideally looking at. So over a period of next few quarters, you will see margins coming down, but there'll be enough growth to take care of profitability.
Right. And with this, when you're talking of the margin front, when you're talking of even in terms of growth, where are you expecting growth to come from if you have to take different segments of business?
See, for instance, till about 1 year back, we were largely into tier two, tier three, tier four kind of cities,
Mm,
focusing on small ticket, largely on construction, purchase of plot, composite loans, and bit of resale and purchase.
mm, mm,
Now, because of our pricing, we have power now to compete with most of the big banks. Now we can focus on developer market with respect to retail lending. So now we have the entire opportunity has opened up. So now we have, it's a large space. So we can now compete with almost all the banks in top 20, 25 cities. Now that is something which was not there for us. Maybe it was 2, 3% out of our overall incremental sourcing. Now, even if that goes up to 15, 16%, there'll be huge lift in disbursements. And I think that has opened up now. Earlier, that was not a focus. For example, focusing on 50, 60 lakhs within the city was not a focus, but now that market has opened up. So in
Hmm.
that sense, our tickets is also might see slight increase going forward.
Right. And with regards to even the breakup, salaried professionals is almost 70-72% of the portfolio. Non-salaried is around, say, 28-29%. Builder loans is still very negligible. Do you think that quantum is something that would increase? And if that increases, do we see any risk on the asset quality front?
I guess you're talking about when you say builder retail, right? So
The builder
today,
loans.
exactly. No, it's not construction finance, it is retail.
Hmm. Hmm.
Funding of apartments. Today in a portfolio, builder loans are 25%.
Okay.
Now this 25 will maybe increase over a period of time, and we don't see any risk at all because risk actually comes in, with the nature of loan, whether it is lab, whether it is home loan or non-home loan. Number one, number
Hmm.
two, profile, whether it is salaried or self-employed, non-professional. Here we are talking about builder and non-builder. So
Hmm.
builder, non-builder, there is no much of difference with respect to risk. There is some risk, but the risk is no, it's very hardly anything. It's negligible. So that will not increase our risk at all drastically.
Right. And from here on, now that we are seeing that in terms of pricing, we're pretty much at par with most of the big banks. Do you think competition is something which will impact us, or do you think you've already gone beyond that phase? And with regards to competition as well, the number of financial institutions, the number of banks that are around, how are you defending against competition?
See, we are focused on what we should do as a company.
Hmm.
A cost structure is very good. Our liability mix is the best. So we keep improving that, every other month. So we have the power to price it very, very competitively. So we have to only focus on generating more business and retaining existing portfolio. We're able to do that. So market is really robust and market is huge. So there is enough and more space available for more play. So we don't, as a company, we don't see major competition from whether it's PSU banks or private banks or maybe HFCs or NBFCs. Of course, the book is quite small. So considering the growth what I spoke about, we don't see any risk at all.
Right. And overall as well, when we're talking of disbursements, now earlier as well, we mentioned that Telangana is something which did impact business. How are we placed on that front?
No, that was for 2.5 months in quarter three. So
Hmm.
resumed mid of December. So now there is no issue.
Okay. So now everything with regards to the disbursements in Telangana will be at par.
Yes, yes. Now it's at par.
Right. And overall, with real estate demand, which is surging, what is the situation, especially with regards to where the affordable housing segment goes? Because there was pain on that front. Is that going off as well right now?
No, in affordable space, there was no pain on the demand. Actually, the recovery was quite fast in affordable space.
Hmm.
Maybe there was little pain on the NPF front in affordable space, but not
Okay.
on the demand front. So now, at least for us, NPS we have seen after COVID, after Morat, how it has panned out.
Hmm.
So we are pretty comfortable on the NPA levels, including deemed NPA. Now on demand front, I think affordable space or saw fastest recovery, and now demand is completely back. And we also have changed a little bit on a strategy, and therefore we have now larger market space to operate,
Hmm.
which will propel our growth much faster than what we anticipated maybe a few quarters back.
Right. And overall, on the back of the cost of funds as well, we are at around 5.5%. Do you think there is a possibility that we could go in lower on that front, or is this something that we aim to maintain?
Our attempt is to reduce cost, rather every week on week. So far we've been successful, in that. But I don't think so. There'll be drop in rates going forward. I think there are no indications as well. So it might consolidate at these levels, whether you look at repo rate, or reverse repo rate. I don't think so. There'll be major change at least for next few quarters before it starts moving up. So we don't. I think downward trend may not be much, but it will consolidate at least for next few quarters. So we don't see that risk. So we will try to manage our cost efficiently, and therefore we have that advantage at least for next few quarters. And when rate goes up, it will go for everyone. So we're on.
And with this, now that the home loan rates are lower, do you think that the average ticket size will increase as well? And would you be able to move to metro cities from tier 1, tier 2, tier 3?
Two things, since property prices are still the lowest. Number two, rates have come down to rock bottom levels. So because of these two, affordability has increased, no doubt about that. Adding to this, since we have changed our strategy a little bit, so we were present in metros and big cities, but we were focusing on the outskirts. Now we will start focusing on entire city, not just outskirts, even in the city. So I think that will be additional space for us to operate.
Right. And then very lastly, from here on, from the budget as well, and the RBI policies that have been announced so far, anything yet you think that needs to be done for the housing finance companies?
No, I think enough is done by both the regulator as well as government. I think this is good enough to see that growth picks up both for housing as an industry and also for developers, at least for next few quarters. And then, of course, everything is once back to normal. I think things will be as usual. So I don't think so. I think enough is done for the industry. I think that is good enough to see bright future.
Right. And any fundraising plans that could be on the anvil?
Yeah, we have plans, but we have to time it appropriately. We have plans, but I'm not sure when we are going to raise, but it will not be in near future. It may take few quarters more. Today, if you look at our DER, it is 7.3 after Q3, and CAR is 24 plus. So we are pretty well capitalized, and the leverage is pretty comfortable. But yes, the new discussion paper, which is under discussion, so that may try to reduce the leverage. So keeping that in mind, and also anyway we had plan of raising capital, so we will raise capital. Form, quantum, and timing will decide at the appropriate time.
Right. So Girish, as you mentioned with regards to leverage as well, what is our leverage position currently, and what's the comfortable level that we are okay to deal with?
See, today it is 7.3, and we are pretty comfortable if it is less than 8. But if there are change in the leverage for HFCs by regulator, then obviously we need to. When I say regulator, I'm not referring to what is now available in 12, 13, 14. I'm talking about the new leverage. I think what gets decided once RBI rules out. So we have to align to that, and therefore we also have plans to raise capital. And with every passing quarter, the ratio is improving, so we are pretty comfortable on that. But we will raise capital.
Right. So will a 8 times or a 9 times be okay for a Canfin homes? Will we be comfortable?
No, we are pretty comfortable if it is less than 8. Today we are 7.3, but we also want to align just in case if the leverage stipulation is low in the current level. Yeah.
Absolutely. Thank you, Girish, so much for joining us on the show. Pleasure speaking to you. Good insights, and hoping to speak to you soon again. Thank you and stay safe.
Thank you.